Hi Team Value, JJ here, welcome back. Well, today I'm going to react to a recent interview by famed short seller Jim Chanos. He talks about the stock market, about the golden age of fraud, about Elon's pay package, and many other things, meme stocks included, so let's get into it.
How much does the rate environment overall contribute to the shrinking universe of short selling funds, do you think?
Well, I think the rate environment is probably the first or second derivative. I mean, it's really the ongoing persistence of the bull market, which has now been 15 years. And we saw something similar, Scarlett, in the late 90s, where the number of short biased funds by 1999 and 2000 really had dwindled to a handful. And people just got exasperated. And that was right before there was really 10 years from 99 to 09 of just fantastic returns on the short side. And two bear markets, of course. Right now, what we're seeing in the universe of companies we follow is probably it's as attractive a time as it was in first half of 2021. And I've said publicly that 2021 was the most speculative market I've ever seen in my 45 years of investing. And we're getting back to that. Not quite there, but it's close.
Wow, he's saying that close to 2021, where all those SPACs were around, the meme stocks, and then there was a big down market, a bear market after that for tech anyway. There was an overall bear market, but tech went down 70, 80, 90% in some cases. He said it's getting back to that, but short sellers have been having a really tough time, which is what he indicated there. He has closed his hedge fund, now a family office. So he's indicating here that short sellers are having a really tough time, as tough as they have for a very long time.
And where the stock market is going, I have no idea.
I just did a video today on the stocks today with JJ, a new live channel where I'm doing daily live videos. I'll put a link to that in the description. The channel needs some love. It's new. The YouTube algorithm hasn't found it yet, so go and check it out.
But the fact of the matter is that with the exception of the far right group of companies on the bell curve, most companies underperform the stock market over time or fail. It's the NVIDIAs or the Teslas or whatever on that far right end that go up quite a lot that give you your returns.
Definitely been the case lately with the Magnificent Seven. Those stocks have performed incredibly well compared to most other stocks in the stock market. The huge amount of gains from those stocks alone.
The strategy of being long equity markets broadly and short idiosyncratic names, I still think makes a lot of sense.
Is AI in a bubble?
I have no idea.
You lived through bubbles.
I've gone through bubbles. I'll make one observation as it relates to AI. So if you go back and look at the U.S. economy in the immediate post-internet age, and I think we can all agree the internet changed our lives in a major way. From 1998 to 07, the U.S. economy grew at 3% real annually. From 1988 to 1997, the 10 years prior to really the advent of the internet to the public, the economy grew by 3% annually. The internet had no impact on growth. Now, it had a lot of impact on individual companies, getting back to my point, right? There were big winners and big losers.
Right. The dot-com bubble, a lot of those companies went away. There were a few winners. We think of those big mega caps now. Amazon was there during that dot-com bubble. It had 10 years to get back to where it was in the bubble. Microsoft did well, and we have other companies that were started after that. The Teslas and the Metas were started way after the dot-com bubble.
If AI is going to be as transformational as people think it is, and I have no idea whether it will be or not, there'll be big winners and there'll be big losers.
I just want to follow up on that, though, too, and this kind of leads back to the question Scarlett started off with about the connection between macroeconomic conditions and our markets today, and there does seem to be a disconnect.
Yeah, I wouldn't disagree with that, and I think there's a much more speculative nature of this market, and we started to see it in late 2019 when commission rates got cut to zero, and retail began to come back.
That was when Robinhoods of the world and other platforms stopped trading. There was no fees. They're kind of built in. There's still fees, but they're built in, so investors pay zero per trade. And they went way down during the dot-com bubble. That started, the online trading started then, way back then, and fees were way more expensive than they are now, but they were cheaper compared to what they were before.
In the market in a big way, in ways they hadn't been in. Prior to that, they'd been investing in ETFs or mutual funds or what have you. And we began to see pre-pandemic speculation in individual names really pick up. And then, of course, post-pandemic, it took off. And we're still, you can see it in option volumes and a lot of other sort of quantitative measures that the public is in this stock market in a big way. And that really then means that you have to change your risk parameters, change the size of your short bets, if you will, and be mindful of the GameStops and those kinds of things. On the other hand, generally they chase momentum and sometimes, quite frankly, silly stories.
He's talking about retail investors, commonly called dumb money, as opposed to smart money, chasing momentum. And we do see that with things like GameStop. There's a lot of FOMO involved here.
If you were looking at the AI story, and I get you can't say it's a bubble, but it's spread out in lots of different parts, right? Utilities have been up, power has been up, you have hardware coming up, you got software, like it's like the tentacles are moving out.
Right.
How do you think about something like that? Like, how do you?
Well, we look for, I mean, for one, we look for companies in our world that have gotten the benefit of an AI, kiss, but are actually going to lose because of AI. So we've been publicly short the data centers, the legacy data centers, because they literally are not designed for AI chips. They have to basically be retooled completely.
I've seen him talk about this on Twitter, on X. He talks about this quite a lot. He names those companies, if you want to check those out, what he's talking about there, those legacy data centers that have, some of them gone up in price because of this AI, craze that's going on, the exuberance, but he's saying that they're actually not good. They're the opposite because they can't handle AI. If they'd have to build whole new ones to handle it. That's what his thesis is on that anyway.
And all of the infrastructure and hardware in a data center, an old one, is not compatible with the new chips. So people have bid the stocks up thinking they're AI plays. They're actually losers from AI. And it gets back to the winners and losers thing.
Now, if you're getting value out of this video so far, I really appreciate it. If you're watching on YouTube, if you manage to hit that like button or elsewhere where there is a like button to help the algorithm to spread it to more people, it really does help. And if you're new here, do consider subscribing as well.
How much can a charismatic influencer like Roaring Kitty, aka Deep Effing Value, and what's his actual name, Keith Gill, and an army of day traders keep this GameStop dream alive? I mean, from where you sit and looking at it, at some point it comes crashing down, does it not?
Well, it already has. I mean, so if you look at the meme
But
stock,
there's little blips here and there.
Yeah. But if you look at the meme stock class of 2021, which was GameStop, AMC, Bed Bath & Beyond, a number of others, I mean, with the exception of GameStop, they are all down 90, 95, 99%. It was disaster for retail investors, quite frankly.
It was indeed. A lot of those meme stocks are way, way down. GameStop is going back up again. I just wonder if the same people are in this or if it's a different set of people that are chasing momentum. It is about momentum. There's a lot of talk about, getting back at the man or whatever, but really, is it mostly about that? Keith Gill, Deep Effing Value, certainly stands to do well out of this if he plays it right. He put a meme out saying you were a billionaire, looking at it, that cartoon of somebody looking in a mirror. So if he does well out of this, it does stand to be a billionaire. Is that why he's doing this?
People are still valuing that company, if we're going to value a business, at 3 times its cash. And even though it's raised all this cash, it's got about $9 a share in cash right now per share. I think the stock's at 25 or 26 or 27.
Of course, the company took a really advantage of the share price going up by issuing new shares and raising a lot of cash. So that's one thing they do have, but what are they going to do with it? It's still, is it a great company? Can it be a great company?
And so you have to believe the business has something, or there's option value to the cash, which is what people believe, that Ryan Cohen will be able to do something. That's really hard to do when you're paying $3 for $1 of cash. And again, so you're chasing the future, you're chasing the story. In bull markets, the future gets a premium. In bear markets, reality gets a discount. Overall short interest is down.
Look at that graph there, short interest near a 2-year low. So, there's in the bull markets, the short sellers have not been doing well because the market's just kind of been going up and up. There are exceptions there. Software stocks, SaaS stocks have kind of been going down lately because of AI has been going up. Well, that's the way that I see it anyway, is that I think the market sees these companies at risk if they're going to get disrupted by AI, some of them.
I've called this the golden age of fraud. So there's just so many companies, so many companies now that are playing games.
Golden age of fraud. That means that there's a lot going on in this bull market that he thinks is fraudulent.
That are to try and take advantage of investors. So we need short sellers more than ever.
Short selling is complicated. It's expensive, and it's certainly a risky way because your downside is unlimited.
Very difficult short selling. I mean, Warren Buffett talks about this, that he doesn't do it, even if it seems so obvious. He said he and Charlie Munger, I think they've done it in the past, but it's so difficult. And if you look at companies like Nvidia, I know people have shorted Nvidia and in Tesla. Jim Chanos shorted Tesla for a long time and did not do well because it's really hard to know when they're going to turn. Crazy can get crazier.
You shut down your hedge funds last year, yet given where we are in this market cycle, you say we're in the golden age of fraud. This might be a good time for short strategies in terms of performance. Do you see it getting a little bit easier to raise capital from institutional investors for short strategies?
It's harder.
No?
Yeah, and that's part of why the opportunity set is there. Nobody wants to do it.
But do you think, though, that long-short strategy might actually have some value at some point in time?
Oh, absolutely.
Because, I mean, we talk about this idea. I mean, you can't have a market that's all long. I mean, that doesn't work forever, does it?
I don't think so.
This is the argument that short sellers balance the market. So, they look for fraud. Sometimes they uncover fraud, but they also balance the market in terms of getting too carried away. But even though it's dangerous to short, risky to short, that's the argument that they're needed because they balance the market, which some people just forget about. A lot of people hate short sellers because their favorite company, if it's being shorted, can go down, and obviously people just want their companies, their stocks to go up forever. Of course, stocks that only go up.
I'm puzzled by the number of restaurants that are trading at absolutely insane valuations in an industry that, ultimately is not a secular growth business.
I think he's talking about possibly some of these that have run up things like Wingstop, Chipotle. So Bill Ackman sold down some Chipotle. So I think he's talking about kind of fast food restaurants and from there, and there have been some pretty spectacular multiples in that sector lately. It's not investment advice, though. Might be a good time to say that nothing that I say here is investment advice. I'm not an investment advisor. I'm not a financial advisor. So you need to seek your own advice from a licensed professional and do your own work. What you see here is just for general entertainment, value, and general education.
Tesla is holding its annual general meeting tomorrow, and you were famously short Tesla at a time when it basically defied gravity. We know that shareholders are going to be voting on Elon Musk's $56 billion pay package, not from this year, not from last year, but from a couple of years ago.
Yep.
What is that emblematic of? What does that tell you?
Well, first of all, it might shock some of your viewers, but I tweeted out a week ago, I actually think that people should vote for the package.
Really?
I think, even though I'm a bear on Tesla, I think a deal is a deal, even if it's a bad deal. And they agreed to it. Now, the judge even if they voted in again, that doesn't mean it may happen. It may not obviate the ruling. But I do think a deal is a deal, and that if you voted for it, that he should get it. Having said that, the value of the package is in excess of all the retained earnings of the company's ever made, even post-package. And the one thing I pointed out today, the one thing I've been scratching my head on and going back and looking at this package from 2018 was that the deal was contingent on hitting certain numbers and the stock price hitting certain values. But what they didn't do was make each tranche the new equity award that he got for doing that, the strike price of that option at the stock price at that moment. All of the equity for all of the tranches was set at the original price, which was $23, adjusted for the split. So that means there's really no clawback provision, and basically it means if the stock goes up a lot and then goes down a lot, he still wins. The shareholders don't necessarily win. And in fact, I think the stock price is below where he earned the last tranche already.
That's a good point there, that if the stock goes up way high, and remember it got to well over 400 and then goes way down again, that means that he gets paid. So it's based on based on really the stock price rather than the company fundamentals. And those can definitely be two different things. The stock price can go anywhere. So that encourages Elon really to talk the price up to get paid.
So it's a little bit like a hedge fund manager saying, okay, well, I was up 40% at mid-year and then gave it all back in the second half of the year, but you should compensate me on the fact that, I was up a lot at one point.
Yeah.
And so that's the one aspect of the package I think shareholders should really, be kind of kicking themselves on. I think that the tranches should have been set at each point at which the stock price had to go to.
Good idea.
But having said that, I think he should get it. I'm not a big fan of Elon. There's no surprise of that. But a deal is a deal. It is, however, a very expensive deal for the shareholders.
Do you think it would be better, though, if they structure, I know they can't really restructure, or they can, but if they tried to restructure it, would it be better to sort of make some of those metrics tied to the performance of the company itself, not necessarily the stock, but I'm talking about sales?
Yeah, it was both.
Yeah.
So the award was tied to both, and there was various formulas. Look, anytime you tie it highly to stock, it's problematic because you run the risk of someone being overly promotional to get paid and then worrying about it later. And I've often said that lavish stock option programs are undervalued in the marketplace in terms of their expense, because if you have a board that's very acquiescent, and that's Tesla, and you don't get fired for aggressive, risky behavior, if you engage in risky behavior to get lots of stock option payouts and it doesn't work, it actually becomes in your self-interest to have the stock price go down so you can reload at lower prices. So in effect, when you've issued call options to an executive, in that case, you've also issued them put options. And a lot of people don't realize that.
Well, that was Jim Chanos, famed short seller. What do you think of short selling? Do you think it is beneficial for the market sometimes, or do you hate short sellers and wish that it didn't exist there? Do you think they keep the market in balance? Let me know in the comments. I'd be really interested to know what you think of short selling in general. Do you do it? I mean, I certainly don't do any short selling, and I take Warren Buffett's advice on that it's a really risky thing to do. Now, as I said, feel free to join me on the Stocks Today with JJ channel, where I'm doing live videos daily at the moment. I'll continue doing that. Finance news, stock market news, reacting to the news of the day. I'll put a link in the description to that, as I said, and see you over on that channel. Do subscribe there as well as here if you want to. And thanks to everybody for watching or listening wherever you're doing that, and I'll see you in the next one.